Today we'll talk about why do traders continue to trade in spite of incurring losses, and what does the latest SEBI report dated 23rd of September 2024 reveal in this matter. To safeguard the retail investors' money, what are the recommendations made by Padmanabhan Committee to SEBI in this regard? What is the tentative date of implementation of these recommendations? And lastly, we will learn about the entities who are benefiting from these loss-making retail traders' money. First of all, let us look at the report published by SEBI on 23rd of September this year. So this is the report that I downloaded from SEBI's website. So this is the latest SEBI report which was published on 23rd of September 2024. As per this study, 9 out of 10 individual traders in the equity F&O market have incurred significant losses, and the aggregate losses of individual traders exceeds 1.8 lakh crores over the last 3 years. Key findings of SEBI: 93% of over 1 crore individual F&O traders have incurred an average loss of 2 lakh rupees. And since the stock market is a zero-sum game, then someone might be making money out of the pockets of these retail investors. So who are these people who are making profits out of the pockets of these retail investors? So they are specifically proprietary traders and foreign portfolio investors, because they have booked a trading profit of around 33,000 crores and 28,000 crores respectively, and that too in this financial year only. So what is this modus operandi of these 1% profitable traders? The modus operandi is they are using trading algorithms, and the proprietary trading firms are using the algorithm trading. So these are machines that are trading for these 1% traders, and they are using these machines to generate profits, huge profits. So lastly, in the consecutive years of losses, more than 75% of the loss-making traders continue the trading. So this clearly shows the addiction that these retail investors have when it comes to the stock market. Now we'll talk about Padmanabhan Committee, which was set up by the Market Regulatory Panel to restrict the usage of derivatives and options by the retail investors who have low risk appetite. SEBI is worried about the explosion in the volumes in the last half hour of the trading, especially on option expiry days each week. So options priced far away from the prevailing market price turn cheaper on such expiry days, and thus attract lots of retail traders who bet huge amounts despite having low odds of success. So keeping in view all of the above, Padmanabhan Committee made the following recommendations. The first one is increasing the minimum lot size of derivative contracts from the existing 5 to 10 lakh to the revised 15 to 20 lakh, and then finally to 25 or 30 lakh after about 6 months. Having just one index option expiry per week in place of the current 5 a week. New clients accessing the derivative segment shall have to disclose additional information, including their annual income levels. Fourthly is, from 1st of October, as announced in the Union Budget for this year, the tax on options will rise from the current 62.5 rupees to 100 rupees per lakh. This thing was already announced in the Union Budget. So here is what SEBI plans to do by accepting the recommendations made by this committee. The first one is they want to reduce risky trades. Fewer options available each week, so people cannot gamble too much. They want to make trades more expensive, so that they want people to think harder before making big risky moves. Make the market calmer by slowing things down, so that there are lesser gap ups or gap downs in the market, and it is safer for everyone involved. Now we will talk about the profits made by the brokerage houses. I have chosen Zerodha as an example, as its results were announced recently. So all of you know Nitin Kamath ji. He is the co-founder of India's second largest retail broker, Zerodha. And after posting a profit, you know what the first message that they put on the Twitter handle is? They are anticipating a 30 to 50% drop in the firm's revenues when the measures recommended by this committee materialize into regulations. And they are saying it might happen sometimes in the next quarter. This is what Nitin Kamath says. So we can safely infer that these recommendations might get implemented from 1st of October 2024. Nitin Kamath ji's company Zerodha posted a revenue of 8,320 crores in the financial year. When a trader trades in the stock market, there is only one person which is making profits, and that is the brokerage firm. So just to give you a perspective and background, Zerodha made rupees 4,700 crores in profits in this year. So even while reporting these huge profits, they and the newspaper, what they're talking about? They're talking about the future losses that this company might incur. Just look at how smart the marketing is getting these days. So by highlighting the profits made by Zerodha, my intention is not to defame this company. Please understand this. This was just an opportunity in the stock market which was waiting to be milked. And Zerodha and the likes sighed before others and milked it and made profits out of the retail investors' pockets. If it would not have been Zerodha or others, it would have been definitely somebody else.